Good morning and welcome to this Monday, June 12th, 2023 edition of Trading Places Live at EarningsBeats.com. I'm Tom Bowley, Chief Market Strategist here at EarningsBeats, and I'll be your host for the next 30 minutes, featuring everything you need to know as you prepare for the trading day ahead. Well, we've got some pretty important changes that I want to talk about here at EarningsBeats before we get started, and I'm going to show you the first one right now. Actually, Tyler, I might need your help here for a second because it's telling me the host has stopped the video. I am clicking on the video, but it's not allowing me to start it. It says you can't start your video because the host has stopped.
Oh, sorry, I was muted. I'm not sure why that would be. I tried to start my video, but that didn't do anything. Maybe if I stop my share, try it now.
Nope.
We'll have to troubleshoot that. I'm not sure.
All right. Well, we had a surprise set up for everyone, but we'll do it again maybe on Wednesday when we have the show. We're actually going to start broadcasting live as far as video. So you'll be able to see me while we're doing our presentation. We worked on it this week, but we tested it this morning and it worked out. But right now it is not working. So that's all right. We'll that'll be a surprise for later. But we do have a couple of other changes coming up that I definitely would like to talk about a little bit. So first, we've got I think beginning on Monday, July 8th, we will no longer be having our Trading Places Live starting at 9 a.m. So Mondays and Wednesdays, those shows will no longer be. However, what we're going to do is we're going to add 2 live shows during the market day, during the trading day. So on Tuesdays and Thursdays, when I normally do my shows over at Stock Charts TV, those will still be, well, right now they're at 9 o'clock in the morning. They might get moved. I'm working with Stock Charts. They might get moved just a little earlier. They could be 8:30 Eastern, so that they would then finish a little bit before the market opens. They would then end around 9 o'clock. So you'd have about 30 minutes after that show before the market opens. And then at 10 o'clock, we will have a Trading Places Live show, but it will be members only. So we're going to be taking a look at the market as it opens. First half hour is going to be in our, in our back pocket. And we're going to start taking a look at the market, going through chart lists. We'll be looking at our scans. We'll have regular segments. I plan to do like a mailbag segment. So when members write in and have questions, I want to be able to try and answer those relatively quickly, but do it in a fashion so that all of our members can benefit from the answers rather than me just respond to one member at a time. But there'll be a lot of different segments like that, and we'll try to keep things very structured. So for instance, 10 o'clock to maybe 10:05 will be a quick little market update, what's been happening in the first half hour, trying to get our feet wet. We may go into a couple of individual stocks that maybe are making noise that particular day. And then we'll go into the next segment. And it might be where we look at our chart list or maybe run scans against our chart list to show folks exactly how to use all of the vast resources that we provide to our members at EarningsBeats. So got some things there in store. I'm really excited about it because we've had a couple of live trading sessions. We've had 2. We had one back in February, and then again a few weeks ago. And we had such positive response with members wanting more and more of the live trading action. So we may still do a full day of, like we did in the past, but I think this will be maybe a little compromise. The Monday and Wednesday show, instead of being at 9 o'clock in the morning before the market opens, we'll move those to Tuesday and Thursday at probably about 10 o'clock Eastern, so that we'll be able to go over a lot of the things that are happening live in the market. So also with those live 10 a.m. Sessions. After they're over, we plan to obviously offer the recordings up to our members, but they will be time-stamped, detailed time-stamped. So if I'm talking about Tesla, you're going to know that at 10:07 point, 10:07, 30 seconds, I'm talking about Tesla. It might even have like a little description, why I think it's a buy, or maybe it's pulling back to a key support, something like that. So if that's something that interests you as a member, and you don't want, you can't come in live, but you want to look at the recording, maybe over at lunch or maybe later in the day, because it'll take a little bit of time for our post editing to get these webinars up and ready for you to review the recording. But when you do, you should be able to very quickly zero in on the areas of the market that you're interested in. I plan to have segments that maybe address our portfolio stocks, maybe one segment in one of those two shows where we'll go through, and I don't know if we'll have time to go through all 30 stocks that are in our portfolios, but maybe the 5 or 10 that are either at support or maybe at key resistance or doing something that I feel like our members need to know about from a trading perspective. Those could be featured. So anyhow, a lot of exciting changes coming up. I'm really excited about this. I think this is going to be something that'll be extremely beneficial for our members. For those of you who maybe are not members, but would like to become members, it's going to be a great time to join. You can always get your 30-day trial. But anyway, we're going to talk about this more. I'm really sorry we weren't able to get the video going this morning.
Hey, Tom, actually try the video right now.
There I am. Tyler was doing some troubleshooting in the background. So
yep, you got it now.
Here I am. I don't know, this may be offensive to some, but you're going to have to deal with it for most mornings, because I think we're going to go ahead and stick with this as we go forward. But hopefully, and I think you're going to be able to control, the size of your screen, or whether or not, you're just watching me or just watching the stocks, or maybe a combination of both as I go through the charts. But let me go ahead and share my screen, make sure this is still going to work. All right, you should have now my screen showing 12 stocks. I usually do 10, but here I've got 12. So what I've done is I've added the NASDAQ 100 and I've added the transports, and I've just taken out the NASDAQ. NASDAQ 100 and the NASDAQ are very similar. I prefer the NASDAQ 100 because I track the QQQ a lot. I trade the QQQ a lot, and that is designed to track the NASDAQ 100 or the NDX. So you'll see that. Then down the bottom, rather than go through a handful of sectors, I've only got 3 sectors that I'm showing. So I'll show you a couple, 1 or 2 strong ones, 1 or 2 weak ones, and then I give you 3 stocks. And these are probably 3 stocks that made decent moves on Friday, and we'll be able to go through that. So here's another, maybe a little bit more of a minor change to what we're doing. But taking a look at this chart right now to give you a quick update. You can see from Friday's action, the Dow Jones Industrial Average finished up 43 points, S&P 500 up 5, NASDAQ up 44, mid caps down 15, small caps down 10. So that was a big reversal we saw toward the end of last week. We saw money rotating back into the more aggressive NASDAQ and less so into the S&P and the Dow, and certainly away from mid caps and small caps. I don't know whether that's going to, I guess we'll have to continue to watch the rotation to see whether or not that is something that, that was just a very temporary thing into the mid caps and small caps. But we did get some pretty significant breakouts, as you can see, on the mid caps, taking out the congestion that we saw back at the end of March and throughout April. And then also the small caps taking out the reaction high we saw right at the end of March as well. So as we pull back, that broken area of price resistance should offer us up some pretty nice support. So let's watch for that on any pullback. What I told members at the end of last week, we were trading the small cap index, particularly the IWM, and the TNA tracks the IWM 3 times. And so we were into the leverage because we liked the small caps. We liked that congestion. We really started to see signs that we were going to break out of it. So rather than just ride the IWM, we rode the triple leveraged TNA. Had the big move. We stalled a little bit toward the end of last week. And so I wrote an email to our members and said, I'm getting out of the TNA. I don't think this is a good market to be leveraged in at this point. And we'll see what happens from here. I mean, there'll be opportunities. I like to get in these leveraged ETFs when they're going in one direction. I do not like being in when we get into the whipsaw back and forth. I definitely don't want to be in them when we're breaking down. Or maybe we're hitting a key price resistance level with a negative divergence in place, something like that. Anytime I'm a little bit cautious, I want to be out of leveraged ETFs because they do, as you go through periods of volatility, you go up, you go down, so forth, you're going to have an issue with erosion. These ETFs do not perform as designed over long periods of time. They will do fine following a trend. And because of the nature of compounding, a lot of times these leveraged ETFs during an uptrend, if you're in on the long side, these 2 times and 3 times ETFs will do even better than their underlying index, better than 2 times, better than 3 times. And it's because of the compounding nature. But anyway, moving on to the sectors, discretionary led on Friday. We saw technology also perform well on Friday. The laggard was materials. So the XLB, after breaking back up above the 50-day moving average, went right down, back down below it. So we're continuing to see this volatility. No really sustained uptrend just yet in some areas of the market like materials. Although if you look at discretionary and technology, excellent trends to the upside. And what that tells me is that the big Wall Street firms are rotating into the more aggressive areas. That is not what they do as you prepare for a big move to the downside. When I'm talking about big move, I'm talking about resumption of a bear market. I'm not talking about a pullback. Big Wall Street firms don't necessarily get in and out for every move up and down in the market. So I don't look at it for that reason. What I look at it for is to see if we're getting that rotation that potentially sustains the S&P 500 advance. And what I'm seeing right now absolutely sustains that advance. But that does not cover up the problems we have this week with options expiration. And I'm going to talk about that in just a couple of minutes. Individually, looking at some of the individual stocks, Match.com had a big week big Friday, jumping 6.5% and actually closing at about a 3-month high. We haven't seen a close up above the 41.5 level since back in, that was late February, early March. So Match starting to make a little bit of a move. The PPO looks strong. AD, not so great. I mean, it's okay, but it's been downtrending. I mean, we're jumping a little bit here in the last few weeks back to the upside on the AD line. But overall, it's still in a downtrend. That makes me just a little more cautious than if the AD were actually trending higher. Tesla, another big day. Look at the AD line on Tesla. This is a completely different animal here. Tesla, the AD line continues to strengthen. You've got the price action going up. PPO looks great. This is one of the reasons why over the last couple of weeks, I've been telling members the discretionary group looks really strong because the 2 key individual stock components of the XLY are Amazon and Tesla. And Tesla, you can see on the chart right here, it's been going straight up. Amazon hasn't been much different. We've been seeing Amazon performing pretty well as also. So those 2 stocks, when they're going up, the XLY tends to follow suit. The other thing is when those 2 stocks are moving up, the XLY tends to outperform the XLP. And that ratio had been lagging for a while. Now, our EarningsBeats members know we do some proprietary research, and I use a user-defined index at Stock Charts to track the intraday XLY, XLP that ignores gaps. And while the XLY, XLP was actually trending lower for a while, which didn't look so great, if you stripped out the opening gaps and you looked at our proprietary user-defined index, the XLY versus the XLP,
I'm not sure what just happened, guys. Let me give Tom a call.
All right, I think I lost everyone there for a minute.
Yeah, you're back now.
All right, looks like everything's back up. I'm not sure what the heck happened there, but anyway, what I was saying is that these big Wall Street firms, if they want to accumulate a stock, they don't put market orders in at the opening bell. They don't take advantage of lower prices at the opening bell because there's not enough liquidity in the market. So, you know, if you're a Wall Street firm and you want to buy 1 million shares of Apple, you don't put a market order in at the open. Market makers will accumulate large orders for their institutional clients, and they do so throughout the trading day. So when I see, you know, the market in such bearish fashion in 2022, and I see all of these gaps, and I've done an analysis showing QQQ and the spider and how they trade during the day. And when you get past May of 2022, the weakness that we saw was almost all opening gaps and the first hour of trading. It was all manipulation, in my opinion. From 10:30 or 11 o'clock in the morning Eastern time through the closing bell at 4 o'clock, we saw mostly buying in the second half of 2022. And that's why I kept saying this market is not setting up to go lower. The bear market is ending. Wall Street doesn't buy QQQ. We don't see money rotating into the aggressive areas like that ahead of another big downturn. It's not the way the market's going to work. Wall Street's ahead of everybody else. If you can figure out what they're doing, you got a much better chance of succeeding. And that's one of the things that we like to look at EarningsBeats. So anyhow, looking.
Hey, Tom, you'll need to
lines,
share your screen again.
You know, on a much smaller level at individual stock level, but I think they give us some pretty good clues. And if you look at Dish, the last chart I'll show you here, Dish was, oh, wait a minute. My screen didn't share when we went out. So here we go. So here's the chart of Dish. When you see Dish going up here like this, look at the AD line. That right there is a problem for me. First of all, we've got a stock that's been underperforming in a market that's been going straight up. So that should be one hint that this is a stock you really don't want to be a part of. But after getting a little bit of a rally, look at where we failed. 50-day moving average, PPO center line. And on this rally, what do you see in the AD line? Do you see any accumulation? Anything that appears to be signs of accumulation? I don't. I see an AD line that just keeps going down. So should I be surprised that Dish took another 12% drop on Friday? No. In fact, if I'm shorting stocks, which I'm not, I don't short in what I believe is the resumption of a bull market. I think we're still in a secular bull market. I think we're resuming it. I said this a year ago. It was almost a year ago today. I think it was June 16th or 17th last year when I called the market bottom. Essentially, what I was looking for at that point was the resumption of the secular bull market, which I believe we're in the midst of. But there's still weak stocks out there. And I think Dish certainly fits the bill there. You can see the AD line going down. Price action continues to be weak. The PPO faltering at the zero line. Those are indications of a very, very weak stock. Okay, let's move on to the 10-year Treasury yield. So there were no significant economic reports due out today. A big one tomorrow morning, though. The CPI will be coming out for May tomorrow morning. That's got the potential to potentially do some damage, you know, to the S&P 500, to the NASDAQ, to a lot of the individual stocks. So that's one thing that I certainly would be keeping on my radar is that CPI report tomorrow morning and any impact that might have. Also, we've got the Fed meeting that'll be starting tomorrow and will end on Wednesday. And that's when we'll see Fed Chief Powell come out with the latest policy statement. I suspect it's going to be a pause There are still some who think maybe we'll get a 1/4 point hike. I don't think so. I think we're going to pause. I think if we did get a 1/4 point hike, I think that would be the trigger for what could be some steep selling this week. All right. So the 10-year treasury yield right now, let's get an update there. Currently we are sitting down 1.5 basis points, 3.73%. And by the way, let's see, we can go over here. Let's take a look quickly at the futures. I don't even think I talked about futures this morning, but right now you can see the Dow. I just use the DIA over at stock charts. If you use the, if you go to the symbol summary and you type in diamond, it'll just give you the pre-market or after hours if it's after 4 p.m. But it'll give you the up to the minute after hour quote. So there's the diamonds up 0.14%. We've got the spider right now up 0.26%, which, by the way, would send the S&P 500 slightly above that 4305 level. That's the key resistance level, and open above it. You know, I think there's going to be so many mixed messages this week with the market. First of all, deep down, I'm very bullish. Short term, I'm very cautious, not bearish. Cautious is a different term than bearish. I recognize that there are a lot of increased risks this week. And as a result, I've gotten out of my leverage. All my long leverage is gone. I have none. I think that's the best way to approach the market right now. Now, whether or not you're long, whether you're short, that's an individual call. I do think that there is the potential for a drop this week, maybe even a fairly significant drop. And if we get it, I'm sure the bears will be all over it, that this is the move to the downside. I don't believe that at all. But if I can lessen my risk and we get that drop, I'm going to be jumping right back in to leveraged ETFs as we near major support levels. And of course, I'll be going through those with our members throughout the daily market reports that I offer. And I'm sure we'll talk about it on some of the shows a little bit as well. The QQQ, though, is having the best start to the morning. You can see up almost 0.5%. And so that one is going to be back up pretty close to the recent highs. That 356.21 is very close to where we finished or where we traded at the highs during last week. IWM, small caps, up just a little bit this morning. So still got a little bit of work to do to get back up to the recent high around 188. But this is going to be an interesting week. This is the week I always refer to as opposite George week. If you're a Seinfeld fan, you'll know the episode I'm talking about, where George Costanza, always down on his luck, always very pessimistic. Nothing seems to ever go right in his life. And he's sitting in the diner with Elaine and Jerry. And, you know, he sees an attractive woman walk up and he's like, you know, wow, you know, she's really attractive, but she'll never have any interest in me. You know, I don't have a job. I live at home with my parents, blah, blah, blah. And so that's the point where Jerry and Elaine chime in and said, well, if every decision, every thought you have is negative, why don't you just do the exact opposite of what you're thinking about doing? And then everything should change. And George, you know, light bulb goes off and he's like, well, that makes perfect sense. You know, let me try it. And so he tries, he walks up to this attractive gal and introduces himself, says he has no job, lives at home with his parents. And she says, you're cute. And so when I look at the stock market in option expiration week, I look at all the bad stocks, all the bad areas of the market, and I think, you're cute. You know, and all the areas in the market that look so good, not so cute when it comes to option expiration week. Now, that doesn't happen every week. I'm not trying to say that there's a guarantee we're going to see weak stocks lead and the leaders falter. But there is a tendency to do that. There's a financial reason to do that. Market makers are on the other side of a lot of these options trades. And of course, when stocks like Nvidia and Apple and Microsoft and Amazon and Tesla and all these stocks start making moves to the upside, what happens in the option world? All of the calls that have been played over the past several weeks are actually deep in the money. So there's a lot of in the money call premium. But as you move up, very few folks play puts in the money. They're much cheaper if you play them out of the money. So you get a lot of in the money call premium on these stocks and almost zero in the money put premium. And so that leaves things very unbalanced in terms of inventory on the market makers' books between call options they've sold and the put options that they've sold. And as a result, we can see some significant movement. I'll talk a lot more about that tonight. In fact, this is so significant this month that normally I have shows that are on. Normally I have shows that are on Tuesday. We have the webinar for Max Payne on Tuesday evening, and we've already indicated to our members we're moving it to Monday night because we've got the CPI report out tomorrow. Then we got the Fed meeting. We want to talk about the issues before the big economic report comes out. And then, of course, the Fed policy statement on Wednesday, because you need to be aware of what could happen based on all of this options activity. And the only thing I can tell you right now is that the amount of in the money premium that we're dealing with, I've never seen this much ever. It is it's an unbelievable amount of call premium that we have to deal with. And so tonight I want to talk a little bit about what that could mean and the impact it could have on not only the overall market, but on sectors, on individual stocks. Erin Weber sent out on Friday. Well, actually, she sent it out yesterday, but she prepares as of Friday's close a list of individual stocks. They're about, I'm guessing, 125 to 150 individual stocks, mostly big names, showing where they closed on Friday and where their max pain levels are. And it is mind-boggling. Some of these stocks and the amount of in the money call premium. If you're not already a member at EarningsBeats, you might want to sign up for a 30-day trial. That'll get you into tonight's event for free. Or we have a max pain service that you can sign up if that's the only part of our service that you want. You can now sign up for that at a much lower rate. And if you're interested in that, just write into support@earningsbeats.com and we'll make sure you get set up before tonight's event. But this is going to be a big one. It's probably going to be the most important max pain event we've ever had because of the amount of money that's at stake as we head throughout the week. And with all these key reports coming out, I mean, this should be July 4th week because of the fireworks that we could see. Anyhow, let's take a look at just a couple more things before we wrap up. Didn't get through a whole lot today because of wanting to share some of the news and so forth, things we're going to do going forward. But here's the S&P 500. Look at that failed breakout attempt of the August high. That made me a little nervous right there, failing on a breakout. And if I pull up the NASDAQ 100, while we didn't exactly have a failed breakout of August because we've already broken out, you can see that we set a high, pulled back, and then on Friday moved up, tried to break through that level again, failed, and came back down and closed beneath it. So while futures are looking pretty good this morning and probably going to get off to a decent start here in about a minute or so, I have questions as to whether or not this is going to continue throughout the week. It could. You know, when you've got a lot of in the money calls, a lot of traders making money on those individual calls. The problem is you've got market makers on the other side that are kind of, well, they're selling the call, but they can protect themselves. And I would imagine at the time when they sell the call, they do protect themselves by buying the stock, the underlying stock. That's why we've seen an increase in volume with a lot of these big NASDAQ stocks as they've been going up. A lot of the volumes have been picking up, probably because as retail traders buy options and the market makers sell those options, they're also buying the stock. It's called a covered call strategy. And so they're protected. So if the market keeps going up, market makers are not going to lose money. Don't worry about the market makers. They're going to be just fine. I can promise you that. They make money in any kind of market. But if this market, even if it goes up for the first couple of days this week, if we get a big reversal later in the week, market makers can make money on their long positions on the way up. They can close those positions out and start shorting to reduce the amount of option premium that they have to pay out. So this is a really dangerous time of the year that, or of the month, that we need to be aware of. And again, I'll be talking a lot more about this. We set up a special meeting. Normally, I think we do it about 5 o'clock in the afternoon on Tuesdays. We moved it up to 7:30 Eastern tonight so that we can talk about some of these things. And if you can't attend, we send out the recording. I realize it's a little bit later in the evening. Unfortunately, I can't do it earlier. I've got an appointment this afternoon. So 7:30 is the time that I could do it. And so that's when we're going to have this event. So make sure you attend if you can. Again, this is going to be a big one. Last thing I'll mention, and then we'll go over what is happening in the market. I just wanted to show you, this is the consumer price index. And if you look at the annual, this is the 12-month rate of change. Right now, we're sitting at 5.54%, but we topped back literally in the middle of 2022 and inflation. And if you know anything about inflation, when you top, the market takes off. The timing of that top. So if there are folks out there that think the stock market's going to continue to go lower, you better pray for a big CPI report tomorrow. And actually, even without it, you still got Max Payne helping you this week. But further out, you're going to need to see, in my opinion, another big jump in the inflation. Without that, I don't see this market going lower. The other chart that I was going to show you on the inflation, this is a more detailed chart. This shows you the actual core readings for the last 5 years. And down below here, you've got the annual core rate. So again, there's that 5.54%. And then here's the monthly core. And the reason I do this is if you look back to May of 2022, you can see what last year's May core CPI was. It was above 0.6%. The forecast for May for this for the release tomorrow morning is that the May core CPI is going to come in at 0.4%. So if it just comes in as expected, the annual core rate is going to drop. And so I think that's important to realize. Now, if we come in a little bit hotter than expected, I think that could have a negative impact in the market. But again, like I said, from a bearish perspective, what you really want to see is like 0.6, 0.7, something off the charts to the upside. I don't think we're going to get that. But if we did, that would probably trigger a pretty big selling episode, in my opinion. One other thing I'll mention before we go, I wanted to just show you, here's the QQQ for June monthly options expiration. And we're currently, around $356, $357 on the QQQ. But what you can do is go down the strike price. And what I look at is the open interest over here on the call side and the open interest over here on the put side. And as you get down to $357 or wherever we are, right in here, you'll notice that above 357 on the strike price, there are not a lot of puts out there. Maybe a total above 357. Maybe there's a total of 20,000 if you added all these up. Look at all of the in the money call, calls. So if we go below 357 and we start looking at this, 356, there's 13,000. 355, there's 50,000. Look at the round numbers, 355, 350, 350, there's 82,000. 345, 38,000. 340, 61,000. 335, 33,000. 330, 60,000. 325, 60,000. 320, 101,000. 315, 112,000. 310, 21,000. I mean, 305, 42,000. The value of these in the money calls is astronomical. The value of the in the money puts is negligible. So if I always like to use the analogy of a seesaw, so I'm kind of giving away my age a little bit, but imagine all of the money on the call side on one side of the seesaw and all the money on the put side on the other side. It would look like this. It's like if you're on a seesaw, one person goes down, their feet are, the seat of the seesaw is on the ground. The other one, the feet are dangling up here, in the air. That's kind of what happens with option expiration. There's so much in the money call premium right now that the seat is on the ground, and the put side over here, the legs are dangling. Max pain is where you get to a point where the in the money call premium and the in the money put premium are about the same. It's technically the point where market makers pay out the least amount in total premium. It's where they save the most money. That's where the max pain is for the retail trader. And for me, I know the calculation that Aaron did on Friday, and I'll be doing my own calculation today, seeing where we are. But the QQQ is about 10% above max pain level right now. I can't recall a month where we've seen that kind of in the money call premium. So I don't know what's going to happen. Again, it doesn't guarantee us anything, but it's going to be worthwhile talking about it this evening. No doubt about it. AMD, the amount of in the money call premium on AMD and many of these big NASDAQ names that have been driving the market higher over the past couple of months, they have so much in the money call premium. For me, I just wouldn't buy the stocks right now, those stocks, because I just think there's too much risk. For me, it's not always about being, having a guarantee about whether you're going to go higher or lower. It's about managing your risk. And when you go into option expiration week, there's a reason why option expiration week, there tends to be movement back toward max pain. Usually it's to the downside, because normally the market usually goes higher over time. And so when you go into max pain week, normally there's more in the money calls and puts. And I think that's the reason why we see negativity on the S&P 500. This was the chart of the day for our EB Digest folks. And I just showed the 75-year chart of the S&P 500. And then I showed you the average annualized performance of each day of the calendar month since 1950. So this is taking, January 1st, market's always closed, but February 1st, March 1st, April 1st, May 1st, June 1st, all the way through to December 1st, taking all of those trading days and determining what their annualized return is. And if you look, the first trading day of the month is the best trading day of the month. Want to know what the second best day of the month is? The second. So the early part of the calendar month tends to be very strong, and the end of the calendar month tends to be strong. So you have a really strong period, about a 10 or 11 trading day period, where the market tends to be very strong. But I want you to notice from the 19th to the 25th, that is where we tend to really struggle. Now, keep in mind that this month options are expiring much earlier than normal. They can expire anywhere from the 15th to the 21st. Because we had a Friday this month that opened on the 2nd. The 2nd of June was a Friday. Options always expire on the 3rd Friday. So the 15th is absolutely the earliest that options will expire, monthly options. And the 21st is the absolute latest, because the latest of the first Friday can be as the 7th. So you have the 7th, 14th, 21st is your 3rd Friday. But anyway, the 15th to the 21st is when options expire. And then market makers, for anybody who holds on to their options and decides to exercise, they can then move into the underlying stocks or ETFs. And as a result, there's still an impact going into the following week. And so I always look at max pain really toward the end of the week is where things can get a little spicy, and into the beginning of the following week. And when you look at that, the tendency is for the market to struggle. And so again, I'm just throwing it out there. We'll talk about this a lot more later in the event. All right, that's all I had. So let's take a look and see what the market is doing here. I know I'm about 9 or 10 minutes in, but I did want to share that exciting news at the beginning. We've got the Dow Jones right now up about 1/3 of 1%, S&P up 1/4, NASDAQ up almost 0.5%. Look at the S&P 4310, 4305 is the breakout. We got up to 4322, I believe, on Friday is the high. The high in August was 4325. So those are maybe two numbers to be thinking about. I mean, if we break out, the market may just keep going. You know, bull markets sometimes are very confounding. I believe market could go up at any time because I'm very bullish. But this is a time where, in my opinion, the risk is much, much greater. So we'll see. Notice that with the market higher today, we've got the VIX up 6%. So there's a little nervousness picking up just a little bit here with a lot of potentially damaging. I don't know if the news is damaging, but just the reaction to the news potentially could be damaging. So let's keep an eye, watch the market, see how it does today, and join me tonight, 7:30 p.m. Eastern, for our June Max Pain event. I think it's one of the most significant events we do every month, every quarter. And so I'd love to have you there. Make sure you can go over to EarningsBeats.com. Literally just hit on the no-cost trial right there, and you can get a 30-day free trial, and you'll be able to come in. All members can come in, even free trial members. If you just want the Max Pain service, it's a lot cheaper. Reach out to us at support@earningsbeats.com, and we'll make sure we get things set up for you. All right, that's it. Again, appreciate you tuning in. Let me know in the comments, you know, what you think of having me on here on screen. I don't know if this is a deterrent or whether this is a nice addition. Like I said earlier, probably might be offensive to some, especially anybody who's bearish probably doesn't want to see me. They already have to listen to me. But anyway, this was great. We got a lot of great changes coming up. Please like the video. If you like today's show and you like what we do here at EarningsBeats, like the video and make sure you subscribe, and tell your friends about us. You know, anybody you talk to about the market. I don't think anybody's called the market as well as we have over the last, really since the pandemic, but especially over the last 18 months, calling the tops, calling the bottoms, even the intermediate, you know, tops and bottoms. So anyhow, we'd love to have more folks listening in. So help us out in that regard. We certainly would appreciate it. Have a great day, everybody. Happy trading.